All right, let's begin in Asia. Tuesday, we saw a recovery in some Asian markets after that massive bloodbath on Monday. The Nikkei 225, which initially on Monday fell to a level not seen since the Black Market Day of 1987. Black Monday, I think it was. Kospi recovering. The Nikkei 225, 10.23% gain, biggest rally since 2008. The Kospi in Korea, 3.5% gain there. The S&P ASX 200, 0.41%. The Hang Seng in Hong Kong and the Shanghai Composite Index in China still in the doldrums because they still got some issues. Wall Street on Monday, the futures are pointing to a positive open today, but yesterday, biggest drop in 2 years. S&P 500, the tech-heavy Nasdaq. Let's take a look at some of those numbers. Really bearish over in the United States on Monday as investors were fretting over a number of issues. S&P 500 down by 3%, worst performance since September of 2022. The Nasdaq, tech-heavy Nasdaq, 3.4%, an even worse drop. Look at that. The Magnificent Seven, which includes your Tesla, your Apple, your Alphabet, $600 billion loss. When the market initially opened, it was $1 trillion. But do we see a recovery? We're happy to have Daniel Akinwunmi, global fixed income trader with First Ally Asset Management, as we discuss. Daniel, thank you for joining us. Good morning to you.
Good morning.
What do you make of the sell-off that we saw?
Okay, so I would speak about the sell-offs in the U.S. markets first, then the Asian markets. So in the U.S. markets, the sell-off was triggered by Berkshire Hathaway's stake exit in Apple. And I think it was a long time coming because if you recall, earlier in the year, he had exited, Warren Buffett now had exited a certain portion of his holdings in Apple. The market should have been hinted at that time that there was going to be a fire from that smoke.
Right.
So subsequently, his recent exit, almost 50% of his stake in Apple, kind of burst. It actually did burst the AI bubble. And it also brings to mind a report from Goldman Sachs earlier in June that stated that those who had overinvested in the AI space had little or nothing to show for it. Right. Coupled with an Elliott Management report that also said that the bubble around NVIDIA was overhyped and it was set to burst. It was set to burst. So I think it was a long time coming for the tech stocks. And given the fact that Warren Buffett is a finance luminary, he's a legend. We have
the sage of Omaha.
We have trade desks that have mirrored their strategies around what he does. So when the market moves a certain direction, you have the first person, that's the genuine investor that seeks to take a sectorial repositioning. Then you have the bandwagon effect traders. Then finally you have the short traders that want to make money off how the market is moving.
The drop.
So the drop, exactly. That's why the big seven first lost about $1 trillion. Then through hard bargaining or bargain trading, then it picked up and narrowed. They pared some of the losses and it reduced to about 600 billion.
So what do you make of what happened in Japan? Some are pointing to that rate hike, saying that may have had something to do with it. What do you make of that sell-off that we saw? We've seen some recovery over in Asia, but what do you make of what happened over in
So I would liken Asia's story, Japan in particular, to the story of the word to use is transitioning. So you have a child transitioning from a 3-wheeled bicycle to a 2-wheel bicycle.
I'm loving this analogy.
So the 3-wheel bicycle is negative interest rates and the 2-wheel bicycle is positive interest rates. So you cannot, when you're learning to ride on 2 wheels, you don't just start riding without falling. So that's what's happening in Japan. So, and there are other lenses you could look at Japan at. The first lens is negative interest rates. Trading strategies were built around this negative interest rate.
Carry trade.
Yes, carry trading, exactly. So traders were borrowing from Japan to invest in riskier assets. So then there was a concentration. There was a limited number of tickers that investors could pull their funds into. So the concentration effect as well. Then finally, the number of investors that had a larger stake in the Japanese market were foreigners, which is why their exit was tumultuous. the domestic investors were not investing with conviction. So they had foreigners benefit from their low interest rates, make money elsewhere, and now it's higher. So their margin call has widened. So they need to narrow their margin call. So they need to exit these positions and head back into other trading strategies. But if you notice early this morning, it's back up.
Right. The Nikkei,
Yes.
Big jump,
Exactly. So it's back. It's rebounded. It rebounded to the extent that I read the futures market in the Nikkei and the Topics had to shut down for a few seconds because of the barrage of
buy
requests.
Signals.
Yes, the barrage of requests to enter the market again, and you're wondering, was this genuine or an overreaction? Then that also brings to mind algorithmic trading.
Okay.
So you recall that these models are built using events. So how it works is, when this happens, buy. When this happens, sell.
Right.
But you cannot train the models with emotion because there is behavioral finance.
Right.
So the models lack behavioral finance and do not factor some sentiments that should be in place. Hence, they just sell off whenever a condition is met. And that affects the market.
There's no nuance.
There's no nuance, exactly.
Fantastic stuff. I love Margin Call is a great movie. I don't know if you've seen it. 2011, Kevin Spacey, fantastic. We might play that whole movie one day on the show if we can. Now, do you see more buying opportunities, I guess, in the US? We'll see how, I think futures are pointing upwards right now. But with the sell-off that we saw yesterday in America, does that present opportunities going forward?
Yes, of course it always does. Whenever there are sell-offs like that, it should come to mind that, I'm watching a decline in prices. I need to mentally set a target on where to enter. From research, you would have perceived, it would not fall below this level. If it gets to that level, I'm going to hit a buy. And this is what happened in the Japanese market. In the Asian markets, through bargain trading. In bargain trading, investors haven't done the analysis and cherry pick certain companies that have very low intrinsic value. They are undervalued, and they buy them with hopes of selling them higher. So in a bearish market, there is always a buying opportunity. A buying opportunity to buy now and sell later, or you want to sell, then you buy back, like the bandwagon effect traders. So there's always that opportunity.
Man, this is, I think, the most fun I've had talking about the markets in a while. Let me ask you about the US recession fears. Are those overhyped? People are criticizing Jerome Powell, saying the Fed was too slow to act, yada, yada, yada. What do you make of the projections by some that, the US could be heading there?
So, if we were to go by Claudia Salm's rule.
The Salm rule. Hey, man. All right.
The Salm rule states that a country is in recession if the 3-month moving average is higher than 0.5% of its lowest rate 12 years ago.
Preach on, brother.
By the Salm rule, the US is in recession. But according to Fed doesn't seem too bothered about what is happening currently in the jobs market, because the job numbers printed higher than the Wall Street expected, and this impacted fears that the US was indeed in a recession. And this has also affected the general confidence that investors are having in the US. Considering also the fact that investors had expected Fed to cut rates earlier, but Fed says that
data.
Figuratively, Mr. Goolsbee says the Fed is not blind to other data. And they are figuratively waiting with band-aids to aid the economy where they see it ailing. So I don't think they are too concerned right now until there are numbers that convince them to cut. But there's also something called the crisis of confidence. So you're waiting for confident numbers, but then what would it cost? What would it cost the Fed in about 3 or 4 months if they don't cut rates now? So we may never know what it would cost them, but if you want to take a guesstimate, would be to take about 2 or 3 cuts to get to where the US economy should be in terms of where they should have cut. So if you divert a little away from the economy and you look at the number of shutdowns that threaten the US government under Biden's administration, I think that also hints on how the economy is performing. I mean, the U.S. that's the world number
strongest
one,
economy in the world.
It's a model for other markets, and if the U.S. is performing that way, you perceive that there is a weakening somewhere that needs to be addressed. So, I think Fed should cut. The market has even priced an emergency cut at this point in time because of fears of recession. But for the Fed, is the fear of recession enough for them to cut, or is inflation at their target range? That's what the Fed is looking at.
Great stuff, man. I want you to listen to a gentleman by the name of Mark Cudmore. Mark Cudmore is a global macro analyst at Bloomberg, and he was talking up the US dollar as far as a safe haven when there's market turmoil. Let's listen to what he had to say.
The dollar in the short term. In 2008, it was a US-focused financial crisis. The whole US financial system was in jeopardy of going down, and yet the dollar soared. And that was despite the fact that dollar-yen was in free fall back then as well. Dollar works. At the height of financial panic, you do not turn to things like gold or even less so to crypto. They are bets on the monetary policy response that follows. They are the bets that if it gets really bad in financial markets, that central banks will print money again. They are essentially hedges against fiat currency being devalued. But in the moment of financial panic, all these assets get sold off, gold included, and crypto even more so because it's a higher beta version of gold. So therefore, in the very short term, dollar's the only good haven.
Daniel, what do you think? Because I gotta say, I'm with Cudmore there. I've been telling people, in order to, as far as hedging your portfolios and diversifying, that you go to the US dollar. What do you think?
So I think I agree with him 98%.
Okay, we're on the same boat.
Yes, because I mean, it's the dollar. It's the greenback. It's the greenback. It's a strong fiat currency, and historical data also buttresses the fact that the dollar is where you run to. I mean, if you look back to the 2008 financial crisis, the dollar soared regardless of the economic state at that time.
That's right.
So you still want to have dollar holdings. You might want to diversify your investments, but holding the dollar, like he said, I think will save you a lot of pain in this trying times.
However, on the flip side, if everyone flees to the dollar, you're a fixed income guy. What does that mean for, I guess, emerging markets, debt, and the like?
All right. So when you look at emerging markets, you want to consider as well the economic performances of the
respective countries,
the countries raising debt.
Right.
So while let's say 70% of investors might flee to the dollars, to the dollar, I beg your pardon, you also want to consider how economic growth has attracted foreign investors to emerging markets. If you look back at the deal between the European Union and Kenya that was ratified as at the 1st of July, it was Kenya's economic prospects that brought the EU to identify that there was a potential in Kenya. So, I mean, beyond an overview or bird's eye view on emerging markets, the economy is what drives investors' interest in these markets. So while you might go to the dollar, if these emerging markets economies start picking up, if you see growth beyond your expectations, all some of these emerging markets need is a Fitch revised rating. A rating does good enough for these markets. So then you have people flooding these markets, probably in bits. Then they monitor the return on their investment. Then they bring other investors into these markets. So the emerging market is very, very potent. I don't think it would ever be ignored.
Daniel Akinwunmi, I've had a really great time talking about this market sell-off with you. We got to have you back. We got to have you back on the show. First, global fixed income trader, First Ally Asset Management. Thank you so much for your time. Really appreciate it.
My pleasure.